hard reality of how wealth is actually built. Forget the lottery tickets. Forget the crypto schemes promising 10,000% returns tomorrow. Instead, we will build consistent returns through yield farming and sensible crypto investing. True, sustainable wealth is a process, a structure, and frankly, a game of consistent, disciplined effort. If you're ready to stop hoping and start building, stick around because we're breaking this down into the 5 fundamental pillars that support real financial freedom. Before we get into the nuts and bolts, let's define wealth. It's not just having a massive bank account. Wealth is having assets that generate income independent of your immediate labor. It's control, time, and options. Now, let's start with pillar number 1, the engine of wealth, high-value skill acquisition. Most people try to save their way to wealth, and while saving is crucial, it's not the engine. The engine is your income. You cannot outsave a low income. Therefore, the very first step in building real wealth is increasing your earning potential, and that means mastering high-value skills. What is a high-value skill? It's something that is scarce, scalable, and directly solves a recognized market problem. Think about it. Graphic design is valuable, but coding a complex enterprise software solution is more valuable because it scales further and solves a bigger, more expensive problem for businesses. This isn't about getting another degree just to have a piece of paper. This is about identifying what skills are currently in high demand, like advanced data analytics, high-level sales conversion, specialized digital marketing, cybersecurity, or complex negotiation, and relentlessly pursuing mastery in one or two of them. You need to become irreplaceable in your chosen domain. This is your primary source of capital accumulation. If you don't continually invest in your earning skills, you cap your potential before the game even begins. Pillar number 2, the foundation, radical expense control and capital accumulation. Once you have a high income, most people make the critical mistake of immediately increasing their lifestyle. We call this lifestyle creep. They buy the bigger car, the bigger house, and suddenly, they are still living paycheck to paycheck, just at a higher altitude. Wealth builders do the exact opposite. They maintain a lifestyle significantly below their means, creating a massive gap between income and expenditure. This gap is your capital accumulation rate, and it is arguably the most important metric early on. You need to become surgical about your spending. Every dollar you spend today is a dollar that cannot compound tomorrow. People often focus on cutting out the $5 coffee, which is fine, but the real power is in controlling the big 3: housing, transportation, and food. Can you optimize your housing costs? Are you driving a car that depreciates rapidly and costs a fortune to insure? Radical expense control isn't about being cheap. It's about making conscious, strategic choices to maximize the cash available for investment. Your goal in this phase is to turn that high-value skill income into investable capital as quickly as possible. This is the fuel for your wealth machine. Pillar number 3, the machine, strategic asset allocation and compounding. Now you have capital. This is where most conventional advice stops, but it's crucial to understand the strategy. Wealth isn't built by saving money under a mattress. It's built by putting that capital to work in assets that grow and, ideally, generate cash flow. We're talking about real assets, productive businesses, income-generating real estate, or diversified portfolios of stocks, cryptocurrencies, aka digital assets, and bonds. The magic word here is compounding. Compounding is not just a mathematical formula, it is the force multiplier of wealth. When you invest, your money makes money. Then, that new money also starts making money. It's exponential growth, but it requires 2 things: time and consistency. The key is to start early and be aggressively consistent. Automate your investments so that a significant portion of your income goes straight into your asset portfolio before you even see it. Furthermore, strategic allocation means understanding risk and diversification. Don't put all your eggs in one volatile basket. A balanced portfolio ensures that while one sector might be down, others are performing, keeping the overall trajectory upward. Remember, the goal is not to get rich quickly, even with some investments. That might happen sooner than normal. The goal is to get rich, definitely. And consistency in strategic asset allocation is how you do that. Pillar number 4, the leverage, debt, time, and other people's money. Wealth builders understand leverage. They don't fear debt. They respect it and use it as a tool. Leverage essentially means controlling a large asset with a small amount of your own capital. The classic example is real estate, where you might put down 20% and finance the rest. The asset increases in value based on 100% of its price, but you only committed 20% of the capital. If the asset appreciates, your return on your invested cash is dramatically amplified. This is smart debt. But leverage isn't just financial debt. It's also using other people's time, or OPT. This is the fundamental difference between a freelancer and an entrepreneur. A freelancer trades their own time for money. An entrepreneur builds systems and hires people to run those systems. They leverage their employees' time and expertise to create scalable output that far exceeds what they could do alone. This is critical for moving beyond income generation into true business ownership and passive income streams. Finally, leverage includes optimizing your own time. Wealthy people protect their time ruthlessly. They outsource low-value tasks, be it personal errands, administrative work, or minor business functions, so they can focus 100% of their energy on high-leverage activities, the tasks that generate massive returns. Your time is the most finite resource. Treat it as such. Pillar number 5, the defense, tax optimization, and risk mitigation. This is the phase people often overlook, yet it's where massive amounts of wealth are either preserved or destroyed. Once you start accumulating significant assets and income, you move from earning money to managing money. And managing money effectively requires excellent defense. First, tax optimization. Taxes are often the single biggest expense for successful individuals. Wealth builders work with expert CPAs and financial planners to structure their finances legally and optimally, taking advantage of retirement accounts, business deductions, and strategic asset locations like using tax-advantaged accounts or owning real estate. That provides depreciation write-offs. If you are making a lot of money and paying 35% of it to taxes unnecessarily, you are sacrificing years of compounding growth. This isn't about tax evasion, it's about smart planning within the legal framework. Second, risk mitigation. This means protecting your accumulated capital from lawsuits, economic downturns, and personal disaster. This includes having proper insurance liability, umbrella policies, and potentially creating legal structures like S-Corp, C-Corp, LLPs, LLCs, or trusts to separate and shield business assets from personal wealth. You must build a strong legal and insurance moat around your financial castle. One bad lawsuit or a poorly managed financial crisis can wipe out decades of careful building. Defense is just as important as offense in the wealth game. So, let's wrap this up. Wealth is not a single event. It's the result of consistently executing these 5 pillars: high-value skill acquisition to generate powerful income, radical expense control to maximize investable capital, strategic asset allocation for compounding growth, intelligent leverage to amplify returns, and robust tax optimization and risk mitigation to protect everything you've built. It takes years, not months. It requires discipline, not luck. But if you implement this framework, you move from passively waiting for success to actively engineering it. What pillar are you focusing on this week? Let me know in the comments below. If you found this breakdown valuable, please hit that like button and subscribe for more deep dives into financial strategy. Thanks for watching, and remember to hit like and subscribe and share this information with family and friends if you found it helpful. And I'll see you in the next video.